Hey, hi everyone. Welcome back to the Advanced Mortgage Solutions podcast. You're with your host today, Joel Sadler, and our special guest is Greg Miller, who's actually Scott's brother. Welcome, Greg.
Hey there, Joel. How are you?
Yeah, brilliant. Hey, look, Greg, for our listeners and viewers, it's the first time they would have seen you on the podcast. So do you want to give a quick sort of 1 minute introduction to yourself and we'll take it from there?
Yeah, look, I've always been into property ever since the get-go. I remember about 5 years old following my grandfather around as he was looking to buy rental properties, and I've always been a believer in property. Spent a bit of time over in the UK and with him looking at property over there as well, and then got the opportunity once I returned to New Zealand to get into the property myself. So Megan and I came back from the UK and immediately set about buying a whole bunch of rental properties. So we've had them for about 20 years. And then I was in sort of property maintenance and management. And then Scott asked me to join him approximately 8 years ago. So I've actually been qualified for about 10 years now and have been working alongside Scott here at AMS as a mortgage advisor, and totally happy, totally loving it, and really believe, and getting young Kiwis into their first home. We're New Zealand's not doing a very good job of it, but we're absolutely passionate about getting young Kiwis into their first homes. Absolutely.
Brilliant. Oh, thanks for that intro, Greg. Yeah, it's a goosebump moment there. I love the passion. I like talking and interviewing people that are passionate about what they do. So it's good to hear. Hey, so look, Greg, talking about getting young people into properties, today you're going to give us a bit of a breakdown around the government-backed scheme, Kainga Ora. I've heard a lot about it. I don't really understand it and what it actually even means. How does the government, how are they involved, and how does the loan product work? So do you want to give us a bit of a breakdown? Let's start with, what is the loan product? How does it work from a government point of view? And then we can sort of jump through a series of questions and you can run us through it.
Yeah, look, the Kainga Ora first home loan is a fantastic home loan, specifically to get young Kiwis into their first homes. Okay, so these are to help the young Kiwis who just need that little step up onto that first rung of the ladder. They're just sort of struggling. So we're talking about Kiwis who may have a low deposit, and they're just struggling and then they just need that little bit of help. So what here in New Zealand, just to go backwards a little bit, here in New Zealand, with any loan that is with less than a 20% deposit or equity, that is classed as a high risk loan. And because of that, every single lender out there, every single bank will have to insure themselves with that loan, if that makes sense. So what they do, the banks will insure themselves. They will charge the premium onto the client. Okay. Right. So what ends up happening with the Kainga first home loan is, instead of the loan being purchased by a standard insurer that the bank would use, it is actually insured by the government. So because the government is now actually the insurer, the backer, the guarantee of the loan, there are added perks that get added to the loan. So for instance, the applicant would receive much cheaper interest rates than what they would if they got a standard sub 20% deposit loan.
Yeah.
If that makes sense. We can also crucially go down to as low as 5% deposit, which cannot happen with any other loan. If you do have a product that you could go down to 5%, but there is a lot of criteria you'd have to pass. But basically, the Kainga Ora loan does allow to go down to a 5% deposit, and it does allow people to access almost a special, sometimes the really special rates, as if you had a 20% deposit or greater.
Wow. So reflecting that back to you, it sounds like the advantages are, one, you can get a low, have a low deposit as low as 5% without having to muck around with family guarantees and all that sort of thing, because essentially 100%. The government's the backer from the insurance point of view. And then
Good
also you
sense.
get a more competitive interest rate by the sound of it. That's pretty awesome.
That is exactly right, Joel. It is
Right.
an awesome product. And like you
Yeah.
say, I get a lot of people coming in sort of saying, oh, look, we've got our parents as guarantees, or we need to do this, we need to do that.
Mm.
I'm saying, come in and see me.
Yeah.
It's quite likely you can just do it on your own using this loan product. And,
Right.
9 times out of 10, they can just do it themselves. And
Yeah.
look, if you can buy a house yourself, or you and your partner, it's much easier than getting a third party involved who's going to guarantee it, or we're pulling equity out of your parents' home. That just starts to get complicated.
Yeah.
This
Yeah.
product allows so many people just to access the property market just themselves. It's nice and clean. They're the only ones that own the house.
Yeah.
Easy.
It almost sounds too good to be true, Greg. So, what's the catch? Like, did the government, do they all of a sudden partly own the home? Or like, are there any catches? Or give
Look,
us a rundown on catches
that's
and
a
or criteria.
Joel, that's a really, really good question. So,
Yeah.
a few years ago, there was a Kainga Ora loan product where there was this shared equity, where you actually would co-own it with Kainga Ora. Now, what I'm talking about here with the KO loan, this is not that, and
Right.
that loan product actually got abolished in the end. We won't go into that too much, but thankfully, that co-ownership scheme doesn't exist. So we're not talking about any of this. You will own 100% of the property.
Greg, look, so tell me about the criteria required to qualify for this product.
Yeah, look, that's a really good question. So first of all, the main one is to access this loan, you must be a first home buyer. Okay, so you can't access this loan if you want to buy your second home, a batch, a rental property. It is specifically there to get to help those young first home buyers on that first step of the ladder.
Yeah.
Okay, so that's the first thing. There are some nuances around how long you've been in your employment. So, for instance, the standard is you must have been with your employer for the last 12 months. That's your same employer, the same boss, if you like, for the last 12 months.
Right.
If you're not, we can mitigate a bit of that out. So if you've moved to a new job within the last year, as long as you've been with your new employer for more than 3 months and you're in the same industry as what you were in the previous, then in most cases we can mitigate that out.
Right.
But unfortunately, if somebody changed industries, let's say they were in plumbing and now they were doing dentistry, for instance,
Yep. Yep.
within the last 12 months, unfortunately, they wouldn't qualify. We would have to see the 12 months out before they would qualify for that.
I see. That makes sense. And I suppose that's why it's really important for someone to chat to yourself, and a mortgage advisor about the product, right? Because it sounds like there's some fine print, not fine print, but the criteria needs to be met, obviously, to be granted that applicant or that
Yeah,
loan. Mm.
look, absolutely. And it's always great to speak to us first, and we can have those conversations and get people prepared so they can get things
Yeah.
all lined up for a successful application. There are some other nuances around there as well. There are income caps. So for a single applicant, the income cap can't breach $95,000 for a single applicant, and for a dual applicant, that's 100. Sorry, for two applicants, 150,000. So there is that little nuance around it. Again, it is there just to help those first home buyers, and also there's one with regarding the deposit. Now, we can go down to a 5% deposit.
Mm.
However, with this loan, you must use all deposit that would be available to you other than $10,000. So,
Right.
for instance, we can't show that somebody's got, I don't know, $120,000 sitting in their bank, and then they're saying, "Hey, look, but I
Yeah.
only want to use 5% for this
Yeah.
loan,
Yeah.
and
Yeah.
I want to
Gonna milk it.
retain $70,000."
Yeah.
you
Yeah.
know, the Kainga Ora just simply won't allow this to happen. So
Yeah.
you must use all of the deposit fund. And
Mm.
likewise, if you had, for instance, a yacht parked over in Liverpool or a Ferrari parked
Yeah. Yeah.
in your garage alongside a couple of
Stash of
other
gold.
vehicles, that's
Yeah.
exactly
Yeah.
right.
Mm.
They are going to say, "Hey, look, you're not realistic. If you sold them, you're not realistically in the position of a first home buyer who
Yeah.
needs that little step up on the first run
Yeah.
of the
Yeah.
land."
Yeah. So it sounds like, obviously, as you've said a few times, really designed for those first home buyers that are struggling to get onto the property ladder and just need
That's
that
exactly right.
help up. It sounds pretty like a pretty incredible product, to be honest, Greg. Thanks for breaking it down for us. Before we wrap up, are there any sort of final elements you would advise a first home buyer looking at this product to consider?
Yeah, well, they there aren't really any sort of downfalls to this,
Mm.
uh, particularly with the low deposits. So, with as I was saying before, the any loan with less than 20% deposit here in New Zealand will attract that insurance fee, and every lender does pass that fee on to the. So, with the KO first home loan that we're talking about, what happens is the the customer, the borrower, will be charged 1.2% of the total lending amount. So that is the total lending amount required to settle on the property, not necessarily what the pre-approval lending amount is.
Mm.
So that is charged as a one-off fee, but luckily that is just capitalized into the loan.
Wow.
So yeah, for instance, if you loaned $500,000 to
Mm.
settle on a property, the
Mm.
actual loan would come through at $505,200.
Yeah.
But that's it. The fee is absolutely covered, and now you will have access to uh, pretty much the special rates as if you had a 20% deposit.
Wow.
Okay, pretty
Yeah.
much. They're very, very close. You're
Mm.
basically in rock star status
Yeah.
in terms of the interest rates.
Awesome. So it sounds like the Kainga Ora product would be the first cab off the rank to consider. Yeah. Do you qualify? If you do, it sounds like an amazing product. If you don't, we have our secondary options, but they're not as flash as the Kainga Ora product.
That is
Mm.
exactly correct. Yeah.
Yeah.
And that's the first thing that we do here
Mm.
as established. As soon as we establish that it's going to be a low deposit loan,
Yeah.
then right, let's go straight. Do you qualify for what I would consider one of the best low deposit loans
Yeah.
available? And
Brilliant.
then if they don't, we do have other options.
Yeah.
They can, in some instances, sort of attract a higher fee because you're paying that much
Yeah.
higher interest rate.
Yeah.
Today. Yeah.
All right, Greg. Well, look, thanks so much for your advice on the Kainga Ora product. If anyone's listening or watching that wants to get hold of Greg and the team to speak specifically about this product or other options, then go to www.advancedmortgagesolutions.co.nz. You can fill out a web form, pick up the phone, and reach out to the team, and they'll take care of you.
Yep. Love to hear from you.
Thanks, Greg. See you later.
Yep. Thanks, John. Cheers, mate.